Welcome to the Life Skills channel. Today, we will explore a very interesting and extremely useful topic. 7 types of assets suitable for beginner investors. Have you ever wondered how to achieve financial freedom and enjoy a comfortable life in the US? The secret is not to work more, but to invest wisely. But with a wide range of investment options from stocks, real estate, to cryptocurrencies, it is difficult to know which path is right for you, especially if you are just starting out. Don't worry. In this video, I will help you decode the 7 best investment assets for beginners, carefully selected based on safety, profit potential, and feasibility when living in the US. Not only that, I also give real-life examples from success and failure stories to show you clearly that investing is not something far away. If you've ever thought about investing but don't know where to start, this is the video for you. Stay until the end to explore each asset class and understand why investing is the gateway to financial freedom. Start now. Here's the first one. Stocks concept. What are stocks? A stock is a financial asset that represents a small ownership stake in the company that issued the stock. When you buy a stock, you officially become a shareholder with the right to receive profits from the company in the form of dividends or from the stock's appreciation in the market. This is one of the most popular ways to invest, especially in the United States, where the stock market is considered the lifeblood of the economy. Benefits of investing in stocks. 1. High profit potential. Investing in stocks can yield returns that are superior to many other forms of investment, especially when you hold stocks of high-growth companies. For example, large technology companies such as Apple, Amazon, or Tesla have made many investors rich. 2. Easy to trade. With online trading platforms such as Robinhood, Fidelity, or E-Trade, you can buy and sell stocks with just a few clicks. This makes stocks an asset class suitable for both beginners and experienced investors. 3. Diversification of choice. From large technology companies, retail businesses, to healthcare corporations, you can invest in any sector that interests you. This helps you build a diversified portfolio, minimizing the risk of relying on a single industry. Risks of investing in stocks. 1. Stock price fluctuations. Stock prices often change due to the influence of economic, political factors, or the company's business situation. If you do not understand the market, you may face the risk of losing money. 2. Loss of capital. There is no guarantee that you will always make money from stocks. If a company does not operate effectively or goes bankrupt, its stock price can fall sharply, leading to the loss of all the capital you invested. 3. Psychological influence. Large fluctuations in the market sometimes make investors feel confused, leading to irrational decisions, such as selling stocks at a time of sharp price decline. Real story. Let's take the story of John, an office worker living in California, as an example. In 2010, John saved $10,000 and decided to invest in Apple stocks. At that time, Apple's stock price was relatively low because many people were still skeptical about the future of technology products. However, John believed in the company's growth potential. He did not buy and sell continuously, but held the stock for 10 years. By 2020, Apple's stock price had skyrocketed, and his initial investment of $10,000 was now worth hundreds of thousands of dollars. This amount of money not only gave him financial security, but was also enough for him to buy a house that he had only dreamed of before. John's story is a testament to the power of long-term investment and choosing the right company. Advice when investing in stocks. 1. Learn carefully about the company before investing. Before buying stocks, you need to carefully research the company's business operations, financial reports, and growth potential. This is the best way to reduce investment risks. 2. Diversify your portfolio. Don't just focus on investing in one company or one industry. Spread your capital across different sectors to minimize risk when the market fluctuates. 3. Invest for the long term. The stock market can be volatile in the short term, but it tends to grow in the long term. Be patient and avoid being affected by short-term fluctuations. 4. Use investment support tools. Currently, platforms such as Yahoo Finance, Morningstar, or Bloomberg provide a lot of data for you to analyze and make smart investment decisions. Conclusion: investing in stocks is a great way to build assets and achieve financial freedom. But this requires knowledge, discipline, and patience. If you are like John, choose the right companies, and are willing to invest for the long term, you can turn your initial small amount of money into a large fortune. Remember, stocks are not just a type of financial asset, but also an opportunity for you to become a part of the greatest companies in the world. Start your investment journey today. Type 2. Bonds concept. What are bonds? A bond is a type of debt certificate issued by the government or businesses. When you buy a bond, you are essentially lending them money, and in return, you will receive a fixed interest rate for the duration of the bond. When the bond matures, you will receive your original principal back. Bonds are considered a safer investment option than stocks because the income from interest is usually stable and does not depend on market fluctuations. This is why bonds are favored by investors who want to secure their assets and create a regular source of income. Benefits of investing in bonds. 1. Safer than stocks. Bonds, especially government bonds, are considered one of the safest forms of investment. Governments or large companies often have a high ability to repay debts, helping you minimize the risk of losing capital. 2. Stable income. When you own bonds, you will receive a regular income from interest, which is useful for meeting personal financial needs, such as living expenses or saving for retirement. 3. Diversify your portfolio. Adding bonds to your portfolio helps balance out risk, especially when the stock market is volatile. This is a good way to protect your assets during uncertain times. Risks of investing in bonds. 1. Lower returns than stocks. Although bonds are safer, their potential returns are often not as high as stocks. This means that you may miss out on the opportunity to grow your assets quickly if you invest only in bonds. Number 2. Inflation risk. Inflation can reduce the real value of the interest you receive. For example, if the bond interest rate is 3% per year, but inflation increases to 4%, the real value of the money you receive will decrease. 3. Issuing organization's ability to pay. If the bond issuer encounters financial difficulties or goes bankrupt, you may not get your initial investment back. Real story: Maria, a retired teacher living in Florida, decided to invest in US government bonds to ensure a stable income during her retirement. With $50,000 in savings, Maria bought a 10-year treasury bond with an interest rate of 4% per year. Maria receives a fixed monthly income from the interest, helping her pay her bills and maintain a comfortable lifestyle without worrying about the fluctuations of the stock market. Thanks to the stable income from bonds, Maria can rest assured and spend time traveling and visiting her family. Maria's story shows that bonds are a suitable choice for those who want to protect their assets and have a stable source of income, especially at retirement age. Advice when investing in bonds. 1. Choose bonds from reputable organizations. Prioritize bonds issued by the government or large, reputable enterprises. These organizations often have better debt repayment capabilities, helping you reduce the risk of losing capital. 2. Pay attention to the term. The longer the term of the bond, the higher the interest rate, but at the same time, the risk of inflation also increases. Consider choosing a term that suits your personal financial needs. Number 3. Compare interest rates. Before buying a bond, compare the interest rates of many different types of bonds. A good interest rate will help you maximize your income from the investment. 4. Combine with other assets. Use bonds as part of a diversified portfolio to balance risk and maximize returns. Conclusion. Bonds are a great choice for those who want to invest safely, create a stable source of income, and protect assets from market fluctuations. Although the return is not as high as stocks, bonds are still an indispensable part of a sustainable investment portfolio. If you are like Maria, wanting to ensure a stable and secure financial life, consider investing in bonds. Don't forget to carefully research the issuer and choose the type of bond that suits your financial goals. Start investing today to build a solid financial future. Type 3. Real estate concept. What is real estate investment? Real estate investment is the form of buying and owning land, houses, or apartments with the goal of making a profit. This is one of the oldest and most popular types of assets, considered a treasure because of its tangible nature and ability to increase in value over time. Not only stopping at buying and selling, real estate investment also brings a steady source of income through property rental. With the constant development of urban areas and the increasing demand for housing in the US, real estate has become one of the favorite investment channels, not only for professional investors, but also suitable for beginners. Benefits of real estate investment. 1. Tangible assets. Unlike stocks or bonds, real estate is a type of asset that you can see, touch, and use. This brings a sense of security to many investors, especially when they own land or houses in prime locations. 2. Appreciation over time. Real estate prices tend to increase over time, especially in fast-growing areas. This allows investors to accumulate long-term wealth and preserve capital value against inflation. 3. Generate rental income. One of the most attractive aspects of real estate is the ability to generate passive income from renting. This income can help you cover mortgages, maintenance costs, or become a steady source of income. 4. Financial leverage. You can borrow from the bank to buy real estate with a small initial capital, then use the rental income to pay off the installments. This is an effective way to increase your assets without having the entire amount at the beginning. Risks of real estate investing. 1. Large capital needed. Real estate investing often requires a large initial investment to purchase the property, not to mention the associated costs such as repairs, maintenance, or taxes. 2. Low liquidity. Unlike stocks, real estate cannot be sold quickly when you need money urgently. The process of selling a property often takes time and is affected by many market factors. 3. Market fluctuations. Real estate prices do not always increase. Economic downturns, policy changes, or financial crises can cause property values to plummet. 4. High maintenance costs. Real estate requires maintenance, repair, and periodic taxes. If you cannot manage the property well, profits can be reduced. Real story: David, a young entrepreneur living in New York, decided to invest in real estate at the beginning of his career. He found a small apartment in the city center for $300,000. Although he could not afford to buy the entire apartment, David used a bank loan with an initial deposit of 20%. David rented the apartment for $2,500 per month, which was enough to pay off the bank loan and cover related expenses. Over the course of a few years, the value of real estate in New York increased dramatically, and his apartment was revalued to $500,000. Realizing that this was the right time, David decided to sell the apartment and made a large profit after deducting the loan and initial costs. From this profit, he reinvested in a larger property and continued to build his real estate portfolio. David's story proves that real estate investing, when done correctly, can bring huge profits. Tips for investing in real estate. 1. Research the market. Before buying a property, learn about the market thoroughly, including prices, development trends, and demand in the area you are interested in. 2. Choose a prime location. Location is the most important factor in real estate. Areas that are close to the center, have good infrastructure, and high development potential will bring great value in the future. 3. Calculate your finances carefully. Make sure you can afford to pay off your loans and related expenses, even if you do not have rental income for a short time. 4. Plan long-term. Real estate is not a short-term investment channel. Determine your goals and holding period before deciding to buy. 5. Seek professional help. Work with real estate brokers, lawyers, or professionals to ensure you make the right decisions and stay in full compliance with the law. Conclusion: real estate investing is a great way to build wealth and generate steady income, especially in a dynamic market like the US. However, it requires understanding, clear planning, and patience. Learn from David's story and remember that real estate is not just a financial investment, but a long-term strategy to help you get closer to your goal of financial freedom. If you are ready, start your real estate investing journey today. Type 4. Mutual funds concept. What is a mutual fund? A mutual fund is a form of collective investment in which the money of many investors is pooled together to buy a diversified portfolio of assets, such as stocks, bonds, real estate, or other financial instruments. These funds are managed by financial experts who use their knowledge and experience to optimize returns for investors. This form of investment is suitable for those who do not have much time or experience to research the market, but still want to participate in investing safely and effectively. Benefits of investing in mutual funds. 1. Diversify your portfolio. Mutual funds help you spread your risk by investing in many different types of assets. This minimizes the impact of a particular asset falling in price. 2. Managed by experts. When investing in mutual funds, you do not need to worry about choosing stocks or bonds, because everything is taken care of by financial experts. This provides peace of mind for inexperienced investors. 3. Easy access. With a small initial capital, you can invest in a large and diverse portfolio of assets that would require a large amount of capital if invested individually. Risks of investing in mutual funds. 1. Management fees. Mutual funds often charge management or transaction fees, which can reduce the actual returns you receive. 2. No complete control over the portfolio. When investing in mutual funds, you cannot choose specific assets yourself and can only trust the decisions of the fund manager. This may not be suitable for those who want to be autonomous in investing. 3. Unassured performance. Although managed by experts, there is no guarantee that the fund will always be profitable. The fund's performance still depends on the market situation and the manager's investment strategy. Real story: Sarah, a single mother living in Texas, wanted to save for her child's college education. Working full-time and taking care of her family left Sarah no time to research the market or manage her portfolio. So she decided to invest in a mutual fund that focused on stocks of technology and green energy companies. With a monthly investment of $300, Sarah not only felt secure in her stability, but also saw her savings grow steadily over time. By the time her son entered college, the value of her investment had increased significantly, giving her enough money to pay for his tuition without worrying about finances. Sarah's story shows that mutual funds are a smart and convenient option for those who want to invest but do not have enough time or knowledge to manage their own assets. Tips for investing in mutual funds. 1. Determine your investment goals. Before investing, be clear about your goals, such as saving for a home, paying for college, or accumulating assets for retirement. 2. Choose a fund that matches your risk appetite. Each mutual fund has a different level of risk. If you want to play it safe, choose a bond fund or a balanced fund. If you want higher returns and are willing to take on more risk, a stock fund may be a good choice. 3. Check the fund's expenses. Look at fees such as management fees, transaction fees, or redemption fees. Funds with lower fees often provide better returns over the long term. 4. Monitor the fund's performance. Even though the fund is managed by a professional, you should still periodically check its performance and see if it is in line with your goals. Conclusion: mutual funds are an ideal solution for those who want to invest without too much time or in-depth knowledge. With the management of experts and the ability to diversify the investment portfolio, this is a safe and effective way to accumulate assets over the long term. Take a lesson from Sarah's story. If you want a stable and convenient form of investment, mutual funds are the choice worth considering. Get started today to achieve your financial goals. Type 5. Cryptocurrency. Concept. What is cryptocurrency? Cryptocurrency, or cryptocurrencies, are digital currencies such as Bitcoin, Ethereum, built on blockchain technology. Unlike traditional money, cryptocurrencies are not issued by the government, but are managed through a decentralized system. This makes cryptocurrencies a unique and revolutionary investment channel. Cryptocurrency trading takes place 24/7 on global exchanges, offering investors flexibility and high profit potential. However, they also come with great risks that not everyone is willing to face. Benefits of investing in cryptocurrencies. 1. High growth potential. Cryptocurrencies like Bitcoin have seen a remarkable increase in price over the past decade. Early investors in major projects have reaped huge profits. 2. 24/7 trading. Unlike traditional markets, you can trade cryptocurrencies at any time, including weekends and holidays. This offers convenience and the opportunity to capture every market fluctuation. 3. Globality. Cryptocurrencies can be traded and used anywhere in the world, helping to connect global finance without the need for intermediaries. Risks of investing in cryptocurrency. 1. High price volatility. Cryptocurrency prices can change rapidly in a short period of time. These fluctuations make the market highly risky, especially for new investors. 2. Security risks. If you do not protect your cryptocurrency wallet well or trade on unreliable exchanges, you may be hacked and lose all your assets. 3. Lack of legal regulation. The cryptocurrency market is still not well regulated in many places, leading to the risk of fraud and legal risks. Real story: Michael, a software engineer in Seattle, invested in Bitcoin in 2011 when it was only a few dollars per coin. He understood the potential of blockchain technology and decided to put his faith in this new asset class. Over the years that followed, Michael witnessed extreme market volatility, with Bitcoin prices sometimes dropping by more than 50% in a few days. But thanks to his patience and faith in technology, he kept his Bitcoin. By 2021, when Bitcoin peaked, Michael had made a significant profit, enough to pay off his mortgage and accumulate a large fortune. Cryptocurrency investment tips. 1. Only invest what you can afford to lose. Cryptocurrency is a high-risk investment channel. Never put all your assets into this market. 2. Learn about blockchain technology. Understanding how cryptocurrencies and blockchain work will help you make smarter investment decisions. 3. Choose a reputable wallet and exchange. Make sure you use secure storage wallets and trade on highly trusted exchanges to avoid the risk of losing assets. Conclusion: cryptocurrency offers an attractive investment opportunity with high growth potential, but it also comes with great risks. Michael's story shows that patience, knowledge, and a little risk can yield significant returns. If you want to try your hand at cryptocurrency, start cautiously, do your research, and always be prepared for any market fluctuations. Type 6. Savings deposits. A solid foundation for any plan principle. Safety first. When starting to build a financial plan, ensuring the safety of your capital is the most important factor. Savings deposits are the first step to protect and grow your money safely and effectively. Known as a low-risk form of investment, savings deposits not only help you avoid the volatility of financial markets, but also create a solid foundation for any long-term financial plan. Savings deposits provide a stable interest rate, ensuring that no matter how the market changes, you can still receive regular profits. This is why many people choose to save, to protect the money they have. Real story: John, a bartender in California, was struggling financially. He struggled to pay his bills each month and had no savings for the future. After learning and realizing the importance of saving, John decided to open a savings account with an attractive interest rate at a local bank. John started with a small amount of money each month, but he consistently deposited it into his savings account after each paycheck. After a while, he noticed that his account had grown significantly. Not only that, saving regularly also helped John form good financial habits and build a solid foundation for his future. Gradually, he accumulated enough money to invest in bigger plans, such as buying a house and preparing for retirement. Benefits of savings deposits. 1. Stable interest rates. Savings deposits offer stable interest rates and are calculated annually, giving you a predictable amount of money you will receive over a period of time. This is especially important if you are looking for a way to grow your capital without taking on too much risk. 2. Low risk. Savings deposits are one of the safest forms of investment, as they are not affected by fluctuations in the stock market or other assets. You always know for sure that the money you deposit will not be lost. 3. Easy access. With savings deposits, you can easily withdraw your money whenever you need it without incurring penalties or fees. This gives you flexibility for your emergency financial plans. 4. Create a solid financial foundation. Savings deposits are the first foundation for you to build financial stability. When you have a certain amount of savings, you will feel more secure when facing unexpected financial situations. Real-life examples. Reputable banks in the US, such as Bank of America, Chase, and Wells Fargo, offer a variety of savings packages with competitive interest rates. Each bank will have its own incentives and conditions, but in general, the savings packages of these banks have stable interest rates, safe capital protection, and easy access when you need to withdraw money. Conclusion. Savings deposits are a simple but extremely effective financial tool. If you are just starting to build your personal finances, saving will help you have a solid foundation to develop bigger plans in the future. Like John's story, with perseverance and planning, you can absolutely achieve your financial goals. Start saving today and let your money grow over time. Type 7. Certificate of Deposit, CD. Increase Profit Safety Principle. Commit to time to receive higher interest rate. A certificate of deposit, CD, is a financial instrument that helps increase the profit from your savings while still ensuring safety. The principle of a CD is very simple. You commit to depositing money in a bank or credit institution for a certain period of time, from a few months to a few years, and in return, you receive a higher interest rate than a regular savings account. This means that you cannot withdraw your money before the end of the term without incurring a penalty, but in return, the interest rate you receive will be significantly higher, helping to increase your capital safely. Real story. Maria, a teacher in Texas, had savings and wanted to invest, but was concerned about the risk. After researching investment options, she decided to choose a 6-month certificate of deposit, CD, at a local bank. Although the amount of deposit was not too large, Maria found that the interest rate on CDS was much higher than that of a regular savings account. After 6 months, she received a decent amount of interest, and her money had grown more than if she had just kept it in a savings account. This not only helped her increase her savings, but also gave her peace of mind, because there was no risk associated with the stock market or risky investments. Maria decided to continue investing in CDS, choosing different terms so that she could take advantage of higher interest rates without having to worry about the volatility of other forms of investment. Benefits of certificates of deposit, CDS. 1. Higher interest rates than savings. Compared to regular savings accounts, CDS offers significantly higher interest rates. This helps you increase the profits from your deposits without taking on much risk. 2. Safety. Certificates of deposit are protected by the FDIC, Federal Deposit Insurance Corporation, at US banks, which means your money will be protected up to $250,000. This gives you peace of mind when investing without worrying about losing your capital. 3. Diverse terms. Certificates of deposit can have flexible terms, from 3 months, 6 months, 1 year, to 5 years. You can choose the term that suits your personal financial plan. 4. Easy to manage. Investing in CDS is easy and does not require you to monitor the market regularly like other types of investments. You just need to choose the term and the amount you want to deposit, then let the account grow automatically over the committed time. Real-life example. Many banks and credit institutions in the US, such as Capital One, Ally Bank, and Synchrony Bank, issue certificates of deposit with many flexible term options, from a few months to many years. These banks offer competitive interest rates, helping investors take advantage of the opportunity to earn profits from idle money. These CDS also have features such as no management fees and the ability to reinvest at the end of the term, making it easy for you to continue investing without worrying. Conclusion. Certificates of deposit, CDS, are an ideal financial tool for those who want to increase the profits from their savings without having to face great risks. With higher interest rates than savings accounts and absolute safety from FDIC insurance, CDS are a great choice to build a solid financial foundation. If you are looking for a way to increase your savings without taking any risks, try investing in certificates of deposit and take advantage of the benefits it brings. Here are 7 types of investment assets suitable for beginners. Each type of asset has its own characteristics, benefits, and risks. However, no type of asset is perfect. Choosing which type of asset to invest in depends on your financial goals, risk appetite, and investment time horizon. Investing is not a quick race, but a long journey that requires patience and careful research. Starting to invest today will bring you closer to achieving financial freedom. But remember, understanding each type of asset and choosing a reputable investment channel is an important factor in protecting assets and maximizing profits in the long term. Start your investment journey today and always stay on track with your financial goals. Don't forget to consult experts and reputable documents to make an informed decision. Are you ready to invest? Share your opinion in the comment section below. And don't forget to subscribe to the channel to follow the next useful videos on personal finance. Let's build a solid financial foundation together.